Growth investing. You invest in companies that are expected to grow fast, like tech companies or new startups. These companies might not make a lot of money now, but the idea is that they'll make a lot in the future. Value investing. This is like finding a bargain. You buy stocks that are cheaper than they should be, undervalued, because the company's doing well, but the stock price doesn't reflect it yet. Dividend investing. You invest in companies that pay you part of their profits regularly, called dividends. It's like getting a little bonus just for owning the stock. Index investing. Instead of picking individual stocks, you invest in a whole group, index of stocks, like all the companies in the S&P 500. It's like buying a basket of stocks instead of just one. Small cap investing. This means buying stocks in smaller companies. They can grow really fast, but they can also lose value quickly. Large cap investing. You invest in huge, well-known companies like Apple or McDonald's that are stable and make a lot of money, but they usually don't grow as fast as smaller companies. Sector rotation. This means moving your money between different industries like tech, healthcare, or energy based on which one is doing well in the economy. Momentum investing. You buy stocks that have been going up in price, hoping they'll keep going up. It's like riding a wave that's already in motion. Government bonds. You lend money to the government, like the US Treasury, and they pay you back with interest over time. It's one of the safest ways to invest, but it usually offers lower returns. Corporate bonds. You lend money to a company and they pay you interest. These bonds are riskier than government bonds, but they can also offer higher returns. Municipal bonds. You lend money to local governments, like cities or states. They often have tax benefits, like not having to pay taxes on the interest you earn. High yield junk bonds. These are bonds from companies that are risky but offer high interest rates because of that risk. Bond laddering. You buy bonds with different maturity dates when they pay you back, so you can get regular payments and don't risk everything at once if interest rates change. Bond ETFs. These are like baskets of bonds that you can trade like stocks. They let you invest in a lot of bonds without having to buy them individually. Tips. Treasury inflation protected securities. These bonds protect your investment from inflation when prices go up because their value increases as inflation increases. Real estate investment trusts, REITs. You invest in companies that own buildings, like malls or apartment complexes, and they pay you part of the rent income. It's like investing in real estate without having to buy a house yourself. Direct property investment. You buy actual properties, like houses or commercial buildings, to make money from rent or selling them later at a higher price. Real estate crowdfunding. A bunch of people pool their money to invest in a big real estate project, like a new apartment complex, without having to buy a property themselves. Real estate development. You buy land or old properties, fix them up, and sell them for a profit. Gold and precious metals. You invest in things like gold or silver. They are often considered safe investments when the economy is uncertain because their value tends to go up when other things go down. Oil and energy. You invest in oil or other energy resources. If the price of oil goes up, so does the value of your investment. Agricultural commodities. You invest in crops and foods like wheat, coffee, or corn. Their prices can go up or down based on things like weather and demand. Commodity ETFs. These are like baskets of commodities, gold, oil, etc., that you can invest in. It lets you invest in a lot of different things at once. Cryptocurrency. You invest in digital cryptocurrencies like Bitcoin. Cryptocurrencies are risky because their prices can change a lot in a short time. Private equity. You invest in private companies, not listed on the stock market, to help them grow and then sell them for a profit. This is a riskier way to invest. Hedge funds. These are investment funds that try to make money using special strategies. They often involve a mix of risky and safer bets. Peer-to-peer lending. You lend money directly to people or small businesses instead of a bank and earn interest when they pay you back. Art and collectibles. You buy valuable things like art, rare coins, or vintage cars, hoping their value will increase over time. Actively managed mutual funds. Professionals pick the stocks or bonds for you, trying to beat the market. They usually charge higher fees for their services. Passive index funds. Instead of trying to pick the best stocks, these funds just track an index, like the S&P 500, meaning they try to do as well as the market, not beat it. Sector ETFs. These are like baskets of stocks from a specific industry, for example, tech or healthcare. You can invest in just that industry without picking individual stocks. Thematic ETFs. Invest in a theme or trend like clean energy or artificial intelligence. It's like betting on the future of certain technologies. International/global ETFs. These let you invest in companies from other countries or around the world, giving you global exposure. Forex trading or foreign exchange. You trade one currency for another, like US dollars for euros. The goal is to profit from changes in exchange rates between currencies. Options trading. You trade the option to buy or sell stocks at a set price without actually owning the stock. It's like making a bet on which way you think the stock price will go. Futures trading. You agree to buy or sell something, like oil, at a future date for a set price. It's a way to hedge risk or make money on price changes. Covered calls. You own a stock and sell someone else the right to buy it from you at a certain price. You get extra income, but you might have to sell your stock if its price goes up too much. Socially responsible investing, or SRI. You invest in companies that are doing good things for society, like helping the environment or supporting human rights. Environmental, social, and governance ESG investing, similar to SRI, but focuses more specifically on a company's performance in areas like protecting the environment or being ethical in business. Impact investing. You invest in companies that are solving big social or environmental problems with the goal of making a positive impact while earning a return. Market neutral. You invest in both buying long and selling short stocks to balance the risks. This strategy tries to make money regardless of whether the market goes up or down. Arbitrage. You make money by buying an asset in one place and selling it for a higher price in another place, like buying cheap tickets to a concert in one city and selling them for more in another city. Technology sector investing. You focus on buying stocks from tech companies like Apple, Google, or Facebook because you think tech is the future. Healthcare sector investing. You invest in companies in the healthcare field like hospitals, drug makers, or health insurance companies. Dividend aristocrats. You invest in companies that have been consistently increasing their dividends for a long time. These companies are often stable and reliable. Tactical asset allocation. This is an active strategy where investors adjust their portfolios by shifting between asset classes, stocks, bonds, cash, real estate, etc. Based on short-term market conditions. It's like trying to predict where to put your money based on what's trending. Strategic asset allocation. This involves setting a fixed percentage of your portfolio to different asset classes and sticking with it over time. For example, 60% stocks, 30% bonds, and 10% real estate. It's like creating a balanced recipe for your money and not changing it too often. Dollar cost averaging, DCA. This is a strategy where you invest a fixed amount of money regularly, like monthly, into the same investment, no matter if the market is up or down. Over time, this helps smooth out the highs and lows, potentially reducing risk. Buy and hold. This strategy is all about patience. You buy investments like stocks and hold them for a long time, years or decades, without worrying about short-term market fluctuations. The idea is that the market will go up over time and you'll benefit from long-term growth. Contrarian investing. You do the opposite of what most people are doing. For example, if everyone is selling a stock, you might buy it because you believe the market is overreacting. It's a strategy that relies on finding opportunities when others are too pessimistic. Short selling. This is a bet that a stock will go down. You borrow shares of a stock, sell them, and then buy them back later at a lower price. If the price drops, you make money. But if the price rises, you could lose a lot, making it a risky strategy. Dividend investment plan, DRIP. Instead of taking your dividends as cash, you automatically use them to buy more shares of the same stock. Over time, this can compound your investment and grow your portfolio faster. The barbell strategy. You split your investments into two parts. One part is very safe, like bonds or cash, and the other is very risky, like stocks or high-growth assets. This way, you're protected on one side but have the potential for higher returns on the other side. 60-40 portfolio. A classic strategy where you invest 60% in stocks for growth and 40% in bonds for stability. The strategy is used to balance risk and return over the long term. The coffeehouse portfolio, a simple, diversified investment strategy where you invest in a mix of asset classes like stocks, bonds, and real estate using low-cost index funds. It's designed to be a long-term, hands-off approach. Risk parity. This strategy aims to balance the risk across different asset classes rather than focusing on how much money you put into each one. For example, if stocks are more volatile than bonds, you may allocate more money to bonds to balance the risk. The permanent portfolio, a strategy that splits your investment into 4 equal parts: stocks, bonds, gold, and cash. The idea is that these assets perform well in different economic environments, like recessions or booms, so your portfolio can weather any storm. Income investing focuses on buying assets that provide regular income, such as dividends from stocks, interest from bonds, or rental income from real estate. This strategy is popular for people looking to create a steady income stream. Social impact investing. This strategy focuses on investing in companies or projects that aim to solve social or environmental issues while also providing a return. For example, investing in clean energy or companies that provide affordable healthcare. Capital preservation. The goal here is to protect your initial investment, even if it means sacrificing higher returns. The strategy focuses on safe investments, like government bonds or money market accounts, to make sure you don't lose your original investment. Income laddering. Similar to bond laddering, this strategy involves investing in assets that pay income, like bonds or CDs, with different maturity dates. This provides a steady stream of income over time without having to rely on one large payout. Inflation-protected investments. You invest in assets that are designed to protect your money from inflation when the cost of goods and services rise. Examples include TIPS, Treasury inflation-protected securities, or assets like gold, which often rise in value during inflationary periods. Sector-specific ETFs. These are ETFs that focus on specific sectors, such as technology, healthcare, or energy. By investing in these, you're betting on the growth of that particular sector rather than individual companies. Leveraged ETFs. These ETFs use borrowing, leverage, to amplify the returns or losses of a specific index. For example, a 2-timed leveraged ETF will try to double the return or loss of its underlying index. They're high risk and used by traders to profit in the short term. Sustainable investing. This strategy focuses on investing in companies that are environmentally responsible, socially conscious, and governed ethically. It's like ESG investing, but with a greater emphasis on sustainability and long-term impact on the planet.